Okay, I'll check that you guys can hear all right. Are you okay for sound over here? Is your sound all right over there? Yeah, no? Good? You guys up the back, you okay for sound? Yeah, I think that's a nod. You okay for sound in here? You good? And you guys are in the middle, right? Okay. So we'll make a start. Usually I like to do a bit of recap, but if I don't keep moving on this topic, I'll run out of time on Friday. So I'll just progress on from where we left off last time. So we're in the section on the equity markets. We're going to now look at the secondary equity markets. So when we're investing in these things, there's these two terms, long and short, that we use, and these will become quite important when we talk about the derivatives topic, not too far away. So when we mention long and short in terms of an investment in a share, what do these mean? Let's take the long. If someone says, I'm long on some stock, say long on Fletcher Building, what do they mean when they say the long? Yep. Okay, they buy it and they intend to keep it. So what's short?
It's like you kind of borrow the funds, sell the, you borrow somebody else's securities, you sell them, and you speak to the client bank for the lower price.
Okay.
You give them back his securities.
The profits, yeah. So basically, if you're long, you buy the security, you hold it yourself. If you're short, what you've done is you've borrowed someone else's security, you've sold it, and what you're hoping is that the price will go down, and eventually you'll buy it back and return it to them, and you'll make a profit on the fall in the share price. So in New Zealand, both long and short positions are completely legal. We don't actually see very much short selling at all, simply because if you short sell, then any capital gains you make is taxable, and that tends to discourage people from doing that, whereas being in a long position is, in general, no capital gains on you. So what about two main types of secondary markets do we have? What sort do we have? There's only two common types. Yeah, go ahead. Exchanges is one, and for secondary markets and equity markets, that's far most common. What's the other one? Yeah, over the counter or dealers. Yeah, so the dealer markets, there's not many of those, but like in the U.S., the NASDAQ, if you listen to a financial report, you'll often hear what the NASDAQ itself did. That's actually a dealer market. So when you trade in that market, you actually tend to be trading with dealers, or something like New Zealand Stock Exchange, Australian Stock Exchange, and so on. They're exchange markets, and the exchange simply provides the facilities for trading, and you trade with other people who want to sell. So in terms of services that they provide to investors, there's two main ones. What are they? Okay. Well, they do that, but that's not the two we normally think of. Okay, so two things that they commonly two things that an investor wants out of these things is liquidity. Okay, so because when you think about shares, shares are issued as perpetuities. They have no maturity date. You can't hold them to maturity and get your money back. If you want to cash out, you have to sell them. And so the fact that there is a secondary market there, then that is what provides you with liquidity for your stock. So basically, if you can't sell it on the exchange, there's virtually nothing else you can do with it. So having liquidity provided by the secondary market is important to you, simply because of the very long-term nature of the stock itself. The second thing about it is that, if you want to value your stock, whether you're a private individual or whether you're a fund manager, often you want to know, how much do I have in my portfolio? How much is my portfolio worth? You need a price, and if there's an active secondary market there, then you can simply go to the secondary market and look up the price on the market, see what it was traded at, and that gives you a price. So those two things, liquidity and price, are the two things that are provided as services to the investors. Now, exchanges, there are some places that still have an actual trading floor. New York Stock Exchange still has a trading floor, but most of the exchanges these days are simply electronic ones. So there's basically a bunch of computers that manage the order book, match the orders, change the ownership, make sure that the funds go where they're supposed to. So the days of the actual trading floor seem to be slowly going away as more and more trading goes to electronic, and both Australia and New Zealand are fully electronic markets. There's no floor where trading takes place anymore. And the good thing about the exchange markets as compared to a dealer market is that all the information about how much is for sale, what the prices are, who wants to buy, what the prices are for those, they're all in one place, and the orders can simply be all matched up together. We've got a couple of little ones in New Zealand. There's one here, unlisted, which claims that it's actually not a share market, but guess what trades on it? Shares. And there's this other one here, ShareMart, which currently only has 4 issues on it. So the main one for us is the New Zealand Stock Exchange, which runs the main exchange and some other minor ones, including a derivatives market. So these are just exchange markets. There basically aren't any dealer markets in New Zealand. But overseas, there are some dealer markets and these secondary markets. Okay, any questions on that before we move to the next one about how on earth the price gets set? Okay, so this one will probably take a bit of time. So we're going to essentially try to answer all these questions in a big batch here. So what I'm going to do, I'll start drawing up an order book for a market. So we've got some stock here that trades, what is called X stock. No relation to the X-Men, of course. And what we'll do is we'll make an order book. So these are prices, $4.05, and we'll just run them down about 10 or 11 cents. So $4.03, $4.02, $4.01, $4, $3.99, $3.98, $3.97, $3.96, and we'll stop at $3.95. Now that's the order book. So currently there's nothing in it, but we can have orders come in 2 ways. Does anyone know what either of the 2 ways an order can come into this book? So there's our order book, got nothing in it at the moment. Anyone know what either of the 2 order types that can come in? Oh, no one knows. All right, so they can come in what's called a limit order or an at-market order. So the limit order, we'll put those in first, is people have put in an order which specifies the number of shares they wish to trade, and then they will also specify the price. And so, for example, let's say we'll put some orders in here. Let's say there was somebody wanting to trade 2,000 shares, and they specified $3.98 there. And we'll put some more across here. Say we've got a 3,000 order there, another 2,000, and then let's say a small one of 1,000 here. And let's say we've got some other orders in on this side of things. So say we've got 3,000 there and another 4,000 for a separate order there, and going down, say we've got a big order in here of 10,000 and 2,000 there, and let's just put 2,000 at this point here. Okay, so we filled them up part of the book with these orders. Now, what would these be? Would these be at-market orders, or would they be limit orders? Any ideas? Okay, so these are all going to be limit orders. Okay, so what they've asked, what the person has said when they sent the order in at 2,000 as the number they want to trade, these are all limit and they are buy orders. Now we're going to put the cells up here in a minute. Limit buy orders. So what this person has said, say for this one here, the 2,000, it says, I want to buy 2,000 shares of X stock, and I am willing to pay a maximum of $3.98 for it. Okay, anything lower than that is great, but nothing. If it's more than $3.98, I don't want to trade. So those are all the buy orders. Now on the other side, we'll have people who want to sell, and let's put them up here. So let's start off, let's say there's 1,500 in there at $4, and let's say we've got several more orders here, say another small one, and maybe a couple of thousand there as well. And then we'll go up in price, let's say here to 2,500 there, say a 3,000 order there, and then we'll put a 5,000 here, and say a 3,000 there, and a 4,000 there. So those are orders. Now these ones again, these will be limit orders, but these are limit sell orders. So that one there, what someone has said, I want to sell 1,500 shares of X stocks. I want $4 or more. If I can't get $4 or more, then I don't want to trade. So it goes into the order book there, sitting at $4, and as long as there's no buyers at $4, it simply sits there and waits and waits. So all these that we've seen we've got in our order book at the moment, they're all limit orders. So when you go to look at the market, you typically can't see all this stuff here. You don't know how many are for sale in terms of, there's quite a lot across there. What's that? About 8,000 for sale here, and then that one there is about 7,000. Can't normally see that, but what you do see is that they will have a best bid, they will have a best ask, and they will have also a last trade. Now, of course, we haven't had a trade yet, so no last trade. On here, which is the best bid? What price is the best bid? Yeah, $3.98 bid is people want to buy, and the top price on that is $3.98. So the best bid is $3.98, and in terms of the best ask, what's that? $4. Okay, so there's the ask there, and the lowest sell price there is $4, and so that's where the market sits at the moment. Okay, so those are all limit orders. Now, what characteristic of this market gives it what we call market depth? Any aspect of that market that would give it what we would call market depth? The range in terms of prices? Yeah, it actually it splits out both sides. Okay, so in terms of the buy side, depth is down in this direction. So the more we have down here, the deeper the market is, and similarly up here, that's the depth on the market there. So when we're talking about depth, what that means, if for some reason all these were executed and these all vanished, then we won't run out of orders. There's still more orders there. So if that entire line got cleared out, there's more down here, and so trading will not stop because of lack of orders. Now, what about the next one down, market breadth? So, breadth? Oh, that was the first one. Okay, what about market breadth? Which aspect of that market gives it breadth? Yeah? Yeah, the horizontal one side. So basically, breadth is basically along this way here. And that's really has to do with how many shares are there for sale, how many different traders are there providing breadth to this market. So it allows us to trade, and hopefully, as trading goes ahead, liquidity will not run out on either side. So let's take an at-market order. So we're going to have an at-market. So we have an at-market order come in, and someone wants to buy. Say they want to buy. No, let's make it a sell. So 3,000, and this is a sell. What happens to our order book when this market order comes in? So it's an at-market order. This is the other type. They want to sell 3,000 shares. What happens to our order book in this particular case? Who gets to trade? Okay, no one sees that. So an at-market order basically says trade at the best prices possible. Okay, this person here wants to sell 3,000. What's the best prices they can get in this current order book? Yeah, 398. 398 is the best price they can get in the current order book. So when this comes on an at-market order, what will happen is that this 2,000 here will be completely executed. So this order will be completed, and it will simply go out of the order book altogether. The next 1,000 will come off this one, so this one will change to 2,000, and it simply goes up to the head of the queue. So what happens in terms of our bids and our ask? The bid's actually unchanged. Still 398. The ask also is unchanged, but now what we had is a last trade, and it traded at $3.98. So that's what's happened to our order book. This one got completely. So that one's gone. Fulfilled. 3,000 was for sale there. This at-market order has used up 1,000 of them, and there's still 2,000 left there for sale. Oh, sorry, to buy. Sorry, 2,000 to buy. Okay, so let's take another at-market order, and we're going to put it on the other side. So we can have another at-market order coming in, and this is we'll put a fairly big one trade in here. What have we got there? 37. So let's make it 10,000, and this is a buy. So a fairly big one come in. Now what happens to our order book in the case that this large order comes in? Somebody said, I want to buy $10,000, 10,000 shares. I want to buy them now, whatever the best price is. What happens to our order book in this particular case? They're going to buy all of these ones? Is that your point? Yep, they're going to take 1,500 there. Now at 3.5, 5,000, 7,000. All of that one, and 500 off this one. So this has now got 2,500 left to trade. So this has actually changed the structure of our order book. It was quite a big order to come in, and it's traded. There was certainly traders there with limit orders that could trade. And so what's happened to our bid, now our bid, which is down here, people wanting to buy, that's unchanged. So that didn't affect that one, so that's still at 398. What's our best ask now? Yeah, $4.01, and the last trade. Yeah, it's $4.01. Even though most of that trade, as you saw, most of the trade actually went through at $4. It completely wiped out all the liquidity available at $4, and it went into $4.01. And so the last trade for this market is now at $4.01. So the interaction between the limit orders, which are placed in the book, and the at-market orders is what drives prices up and down. So if you wonder why, like if you listen to, say, a lunchtime financial report and they say, Fletcher Building rose in morning trading by 5 cents. The reason it would have been risen by 5 cents is because there have been a bunch of limit orders in there, and as at-market orders came in this case probably, if the thing rose, probably more buys came in than sells, then it ate into the limit orders, and the price simply rose as a response to this. So as they used up liquidity, the price simply rises. And if you hear say, price fell, what happens is more sell orders come in, and they use up the liquidity on the buy side, and the price simply goes down. So what is happening is with the limit orders, people have given some thought to how much they want for their shares. They do want to either sell or buy, but they have some clear idea about what the value is, and they're not willing to trade at what they consider to be an unfavorable price. So for people buying at $3.98, they think that $3.99 higher is not worth their while buying it. And that's why they put a limit order in. Similar with sellers, say the person up there at $4.04, they're quite happy to sell, but they think that their shares are worth $4.04 and no less. If they can get more than that, that's fine, but they don't want to trade if they can't get the $4.04. And so the interaction between these two things, the limit orders and the at-market orders, is what drives the market up and down. Now, there's one more other thing in there, market resilience. We haven't put anything in there that makes the market resilient. What aspect of the market, which is still missing from our order book, would make the market resilient? Okay, so basically resilience is basically how quick do our limit orders get replenished. So if we have new ones coming in, new limit orders coming in, this is what gives us our resilience. So let's say, for example, to change our book again. So let's say we have a limit order, 3,000, and this is going to be a buy, and we're willing to pay $3.99. So that simply chugs in here. So 3,000 goes in there, and although no trading has taken place, what you can see as a trader is that the book has been updated. So now the best bid is $3.99. Best ask is unchanged at $4.01, and the last trade is also unchanged at $4.01. So the arrival of the new limit orders, basically the speed at which they come in, are what gives the market resilience. So the three characteristics: the breadth, that's basically how many shares you have to sell or buy at any given price level. Depth is if they got completely used up, is there more behind it? And resilience is basically how fast are new orders coming into this market to replace the liquidity that's being used up. Okay, any questions on this before we move on a little bit? Okay, so there's some switch over thing here. So there's our at-market order, there's a limit order. Now, one of the things that New Zealand Stock Exchange, along with a number of other exchanges, did at one stage, they actually experimented with charging lower fees for limit orders. Now, the New Zealand market stopped doing that. They tried it as an experiment, they didn't like it, and they stopped. But some of the other markets that tried it are continuing to charge less for limit order than an at-market order. Why would they do that? When you think about our market here, what about that market would mean that it's in the interest of the market to charge less for a limit order? Okay, can you be a bit more specific? Okay, right. Now, what do you have to say? Okay. Oh, if there's no match, there's no trade. Oh, okay. So, yeah, okay. I think you're both sort of right on the edge of things. So basically, when you think about what's happening there, and you think, what do we want this market to do? One of the things we want it to do for us as investors, we want it to provide liquidity. The limit orders provide that liquidity for us. So basically, there are people there ready to buy or sell on both sides, not the same ones, of course. And you can simply go in and trade with those people there. And so in one sense, the limit orders provide the liquidity to the market. The at-market orders use that liquidity up. And so the reason they experimented with this was that they wondered if they could improve the liquidity of the market by charging less for limit orders. So that would encourage people to put limit orders in, improve the depth, the breadth of the market, and so it improves the liquidity of the market. Now, some of the ones, like I think it was the London Exchange, tried this and they liked it, and so they charge differential fees on whether you use up liquidity or whether you're providing liquidity. Now, New Zealand market tried it and they didn't like it, so everybody's charged the same. But that's the basic reason why they did it. So there's our three things: breadth, depth, and resilience, which we talked about. There's three pictures. Okay, any question on that before we move on to regulars? Yeah, go ahead. Yeah, they can. I mean, if you put a low price in to buy and the market's rising, your order, if it's a limit order, may never be filled. In the New Zealand market, as far as I understand, they will automatically expire if they are not executed in 28 days. Okay, so if you put it in and it's not fulfilled in 28 days, it expires, so it doesn't get left there. Because unfortunately, some people have put limit orders in the past, forgotten that they had put them in there because they weren't executed. The market takes a tumble, and suddenly they get bought stock that they'd forgotten they wanted to buy. So they now automatically expire them out, basically after 1 month. But otherwise, they can sit there and not execute. Yeah, you can. You just ring up your broker and tell them what you want to do, and they can change it. I mean, one of the things if you're trying to buy stock that is illiquid or sell that's illiquid, what you often do is put one of these limit orders in. And like times I've done this and trying to buy something that's very illiquid, like I put my limit order in, and after a week, if it doesn't trade, I'll ring my broker up and move it. So you need to change it. So at any point, you can withdraw it, you can push it up and down as you see fit. You got a question? Yep. Oh, yeah. These two market orders, the limit order and the at-market order, are like two very broad types. There are many, many different types of orders, and particularly like large institutional orders say they want to sell 1 million shares. They won't throw that on at one lump, and they'll simply piecemeal it. It'll come in maybe over days, sometimes even over weeks or months, in piece by piece. And often they'll use more than one broker and all that sort of stuff. So there's a lot of ways of dealing with these things. Like for illiquid stuff, if you want to do an at-market order, but you're not sure that you're going to completely fill it, I mean, they might use what's called a fill and kill, which means you buy as much as you can at the moment, and then there's no residual order left on there. So there's a wide range of basic variations on the limit order and the market order. You can achieve pretty much anything you want with these things. Reasonable amount of choice in there in how you do this. Yeah. Yeah, I mean, yeah, it's the large institutional order that's piecemealed out is basically to try to minimize the price impact of their order. So if you dumped 1 million shares onto the market, to sell, that order in and of itself will drive the price down. And they're simply trying to avoid either driving the price up if they're buyers or drive it down as a result of their own selling. That's what they're trying to avoid. In fact, there's actually separate markets for them called crossing networks that try to deal with institutional orders and actually keep them off the main markets so that the price signals that these things are not sent, that they basically, their large sales just don't result in them having a poor price simply because of their own order. Okay, any other questions? Right. Okay, so regulators, always regulators around. So in Australia, the main one is the Securities and Exchange Commission. We talked about that in the very first topic, or second topic. Again, like pretty much every exchange in the world, the exchange itself has listing requirements that you as an issuer must comply with. And if you're going to trade on there, typically, you have to be what's called a registered participant or an approved participant, basically a stockbroker to trade. And that gives you some extra protection. Basically, if a company does not comply with a listing rule, usually you'll end up with a trading halt. Can be delisted. These days, that sort of stuff is very, very uncommon. In New Zealand, we have the Financial Markets Authority. That's our new one. And, of course, the stock exchange itself has its own supervision of its own market. And so you've got at least 2 layers of protection there as an investor. Okay, moving on to equity valuation methods. You probably, if you're doing 201, will meet these methods there. Okay. For completeness, we'll do them here. Okay, so in general, how would you value a stock? I mean, these people that put these prices in for the limit orders, how on earth would they arrive at that price? Yeah, go ahead. Yeah. Dividend? Yep. Oh, the free cash flow. Okay, so we'll do the dividends, and we'll leave the free cash flow to 201. How's that? Deal? Okay, so we're going to deal with the dividends. Free cash flow, yep, that's 201 type stuff. Okay, so dividends, okay? That's why you buy a stock. How are you going to work out from the dividends what the thing's worth? Yeah, go ahead. Adjusted perpetuity because stocks are listed forever. Okay. So, yeah, that's one way of doing it. And so, if you think about in the most general terms, this is what you have to do. Is that you simply forecast the future cash flows. In this case, for a stock, it's a dividend. Now, this is if you think about compared with a bond, forecasting the cash flow of a bond is simple because in the bond contract, it tells you when the coupons are, what the rate is, and all that sort of stuff. For dividends, they can go up or they can go down, depending on how the company does, how profitable they are, and whether they want to retain money inside the company for growing it, or whether they want to pay it all out. But anyway, this is the first step, and so identify the size and timing of your cash flows, and that's actually quite hard to do. So there's some forecasting involved there. Second thing is, you've got to figure out the discount rate, which is another name for the required return. And that's actually really quite difficult to do. But if you get through the real 2 tough bits of forecasting things and finding a required rate of return, then simply calculating the present value of them. So the last bit is easy once you've got those 2 tough bits done. And this is a general principle of pretty much valuing any security. You figure out where the cash flows are, figure out what discount rate you want, work out present value. Now, the selection of the discount rate, it does, as we said before, it depends on the risk. And often in many cases, because you don't really have a very clear or very exact measure of risk, a lot of it tends to be around what is the perceived risk of the stock. And so you get things like this happening. 1929, the U.S. had a stock market crash. The market lost 90% of its value over a period of time. And because of that, people thought stocks were really, really risky. And so between then and the end of the 1950s, somewhere around 1958, the dividend rates on the stocks were basically higher than bank deposits, and sometimes quite a lot higher than bank deposits. And then after that point, as people had gone through a period of nearly 30 years without another crash, the perception of risk sort of just dribbled away. And people did not think of stocks as being particularly risky, and so their dividend rates just started going down as people began to bid these things out. Now, if you think about New Zealand, about what on earth this tells us about our market here, here's a few stocks here. Vector, I've got these numbers in January this year. 6.8%, way above any bank rate. Methven at 8.1. Goodman Property Trust, 6.5. Trustpower at 10.4%. These are way, way, way above any rate you can get at a bank. So if you turn the question around and ask, what do New Zealanders think of the stock market? They think it's a really scary place. And so because of the perception of very high risk, they're looking for very high returns. And that shows up in these very high dividend yields. Okay, any questions on that before we chug along? Yeah, go ahead. Yeah, they are. They're gross dividends. But, if you think about the best you can do at a bank today is about 4.1, 4.2%. That's taxable as well. So, whereas often this will include your imputation credits. So you think, let's say, a maximum of 4.2% in the bank, Trustpower at 10.4%. You're looking at, if people must perceive that as being a very risky stock to require that sort of level of return. Of course, the question is whether it really is or not. So if we're going to do preferred stock, they're the easiest ones to do. Usually they have no maturity date. Typically they have a fixed dividend, and so all you got to do is take your dividend rate, which is this D here, divide it by your required rate of return, and that will give you a price. So that's simply a perpetuity, which you probably covered in 201. So these things go up and down in price. Typically in New Zealand, well, the very few we have are actually floating rate things. But in other jurisdictions where they're not floating rate and dividend is fixed, then the price simply goes up and down with the changes in the required return, which again is a change in the perception of the risk. So the risk goes up and down. Risk goes up, price goes down. Risk goes down, price goes up. And that simply reflected in that required return. Now, if you're going to do a general stock that's paying out dividends, the dividends may fluctuate. What you need to do is estimate what those are. Now, you could do it the hard way and actually estimate one after another. Usually what we do is try to make some sort of simplifying assumption about what will happen to the dividends over time. The two common ones is either fixed, so the dividend does not change. It's like the three of them. And if they're fixed, then you simply use this formula here for perpetuity. If they're going to grow, then you usually pick a steady growth rate for them. And the third one is, particularly for young companies, you may see the dividend grow quite quickly for a while, and then it'll reach some point where it'll slow down and become a mature company, and the dividend will flatten out. So if we're going to take the simple one is we're going to say that the dividends are going to grow at a steady rate over time. Then what we need is an estimate of the next dividend. So this is the price at time 0. This is your dividend at time 1. So that's price times 0 there. And so you need your dividend at time 1. And then this here is your required rate of return. And this is the growth rate that you expect for the dividend growth over time. So for example, if the dividend you expect, say, in period 1 is going to be $1, and your required rate of return is 10%, and your expected growth rate is 3%, then you simply divide the $1 by the 0.07. So you simply subtract off your growth from your required rate of return, and that gives you a price for today. So that's one of the simplest models to use. The other one is if the you expect the dividends to grow quickly for a while, and then for the company to enter some sort of mature phase in which growth becomes steady. And so if you have that, you basically have to estimate what these dividends are. So this period here, this is your high growth phase. So you'll grow your dividends quickly over the first however many periods that is, up till T, and that's the end of the high growth period here. And then if you assume that the thing's going to enter into some steady growth period, then all you got to do is work out a price at this thing here, and to do that you need D at T plus 1 divided by the R minus the G. That will give you your price at that time. So you simply add those up, and that will give you your price for today. Okay, any questions on that before you get more of this in 201, you also get more of this in 205 if you come to 205 next semester. Any questions? No? Everything's heavy? Lloyd. Well, that's just if you I mean, what you can do if say you're assuming a steady growth rate is that a D at 2 will be D at 1 plus the growth rate. So and then of course D at 3, 3 is equal to D at 1 plus G squared. Terrible writing on this thing. Yeah, so you can do that if you're going to assume a steady growth rate. This one here is probably a little bit more general that you can actually,
But that's what I mean, it's a variable growth rate. So wouldn't you multiply the previous growth rate for the next cash flow?
Well, you can do that. Yeah, for D1, if you estimated that, and you had a steady growth rate, then you could calculate D2 from D1. Is that what you're talking about, or am I missing the point? Yeah. This one you can vary the growth rate, but if the growth rate is constant, okay, then you can simply calculate. Once you've estimated D1, you can calculate all the rest of these at your steady growth rate, and then at the end, you have this G here. Make that G1. That could well be a different growth rate. Okay, so this one here, I mean, you can calculate this at one growth rate, and then it changes to, and G1 applies at that point, and then a different growth rate applies at this point here. Okay, so but this one does give you a flexibility to actually even put multiple growth rates in the high growth period. Okay, any other questions? Right. The other thing we may want to value is rights. Rights issues are reasonably common, and so value in the right or right of the value of the share. This is the number of shares. So number of shares to buy another one. This is your subscription price here. That one there is stock with the right. So the right actually hasn't separated off. So those things, they're all known. You can look up the price in the market. You can get the subscription price and the number required to buy another stock. from the rights issue data, the prospectus comes out, and you can simply calculate the value of the right and then if you have a renounceable right, which means you can trade it in the market, you can actually work out what the right is actually worth to you, and then if you want to use a limit order to make sure you get fair value for it, you can put that into the market to sell it. And again, you can also work out a fair value for it. And if you want to buy them, set the limit order in such a way that you don't pay too much. But after the rights issue is over and the new shares are coming out, we can actually work out the price of the share. This is after the rights issue is completed. And again, all these symbols being exactly the same thing. So essentially what you got, there's your original shares with the original value. There's the extra share there, and that's simply the number of shares has gone up by 1. So you just work, essentially this is an average of the previous value plus the money that you've paid in the subscription, and that will give you the fair price of the stock after the rights issue has gone ahead. Okay, any questions on that? Right. Stock market and stock market risk. Right, what do we got? About 5 minutes left. Right. I don't really have enough time to start this. I don't really want to stop early, but I'm going to stop early, and we'll pick it up at this point on Friday and get into the stock market risk. This is the one place where we actually try to turn a risk measure into a discount rate. Okay, so if anyone else question, be around for a while. Otherwise, we'll hopefully pick this up on Friday and actually finish this topic off.
Invest.
You want to invest?
What other classes do we need to take? Will we ever be ready?
Every ready to invest.
Yes, we have to learn how to invest. And the stock market is really a dangerous place.
Well,
New Zealand-wise.
We had a big crash in 1987, and again, in our market lost about 75% of its value in that crash. And so a lot of people, you know, that was 1987, and the market bottomed out in 1991. Now, it was a long time ago. But there's a lot of people, say, who were in their early 20s up to about age 40, who still remember that.
Yeah.
And so, like people who came along afterwards, they don't remember that. They didn't live through it, and so a lot of the impression that the market is very scary comes from people who are now probably, probably 45 and older, and they're the people who think that's really scary. In fact, some people and so what will probably happen is you think like what happened in the United States. It took 30 years approximately between the crash and when the perception of the risk changed. And I would expect myself that as we go forward, maybe another 10 or so years, that the perception of risk will probably change as those people, start to stop investing, they're going to start going way down for their retirement. And the other people that are coming through who've never seen a crash of that magnitude probably will not perceive the risk as being as high as they do.
But are we not benefiting from their perception since we're getting a higher yield?
Yes.
If it's really not that dangerous as they perceive it to be.
Yeah, I mean that's the, like, if you listen to people who are very successful investors, when everybody else is panicking, that's when they buy. And when everybody thinks it's a big party time, they think it's great, that's when they get scared and sell. Of course, that's actually really, really hard to do, because if everybody's bad and thinks bad is terrible, so you all get out and like, often the world's genuinely scary.
Yeah.
And for you to have a cast iron guts and courage and go in to buy when the world is actually genuinely scary is hard. But when everybody's partying and things are going great and the market's rocketing up and people are buying and they're pouring in and oh, it's great, the last thing you feel like doing is selling. And so it's hard to do that. But you know, the people who have the sort of the willpower to do it can do very well.
I think I already have a trading account with my bank, but I've never traded before. Would you encourage us to do that?
Well, what I would say, okay, I'm not a licensed financial advisor, so you know, this is free advice, and it's, you know, it's worth every penny you pay for it. What I would suggest is that I'm just getting out of here. That's all. Just winding up nothing. So, what I think for people who've never invested before, have small amounts of money, I think the managed funds are a good place to start. Because it gives you wide diversification for a start off. But if you're genuinely interested in doing it yourself, one of the things that you can get from your manager on a regular basis typically is that they will give you a report, and depends on who it is, depends on how frequent it is. Like for example, one of the most frequent that I know of is Milford Asset Management, and they have a report every month on. So if you're in one of their funds, every month you get a report. In fact, not only you get the report for your fund, you get a report for all their funds. And what that will allow you to do is initially, you know, put your money with a professional manager. It gives you diversification. Of course, you have to pay fees. But if you're genuinely interested in what they're doing and you're learning about finance, as you are, then you can look at what they've done and try to sort of understand what they're doing in terms of their trading. Because often they'll say, you know, we sold thus and so. For this reason, we bought thus and so for this reason, and you can sort of start to try to understand what a professional manager is doing, because ultimately you might end up as a professional manager yourself, you know, managing other people's money. But you know, in terms of managing your own money, I think that's probably like the best way to get it in one sense, because of the diversification you have in terms of the stock market. You know, you get a broad spectrum of stocks, and so you know, overall your risk will be lower than if you just bought one. And it gives you a chance to think about it and continue to read about things until you get to the point where you're actually ready to do it yourself.
Management fund. Okay.
Yeah, that's what I would think is probably the best way to do it. And are you a finance major, I presume?
No.
You're an accounting major?
No.
What are you?
I'm doing a grad diploma in econ. I'm a law major.
Oh, okay.
But I really want to switch to finance.
Oh, okay. So in your PG, PG Dip.com, is it?
Yeah.
And major economics.
Yes, but I'm taking all the finance classes that I'm not supposed to.
Oh, I see. Right. Okay. Well, in one sense, I mean, are you going to do? There's only one year thing, isn't it? Or is it? It's 1 year.
Yes,
diploma?
this is 1 year.
Okay. So are you taking third-year papers?
Yes, I've already done my third-year paper. Not for finance.
Not for finance.
This is my first class.
Yeah. Okay. Well, in terms of investments, probably the best one at third year is the 311 investments paper. That's primarily a stock market portfolio management paper. That was actually this semester.
I still have next semester. I have to
Yeah, it
spread out my
only runs
courses.
once a year.
Okay.
So
I still have next year.
yeah.